What is going to cause the market to revalue this stock? Hi, my name is Gary Mashurs. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I hear this question a lot from my friends in the value investing community. And by the way, they ask it about both stocks that are ridiculously cheap and the market just doesn't care and the stock either stays cheap or becomes cheaper, or they're absurdly stocks that are absurdly expensive and they just become more expensive or they stay there. And they're kind of exasperated and they throw their hands up and say, well, what's going to make the market revalue this? If it's been cheap or expensive before, for the last 6 months, a year, 2 years, why is it going to change? And I think that's just frustration talking, right? And I think it's frustration at the kind of market we're in, and the situation where a narrow group of really price companies are getting absurd valuations in some cases, and then other companies are priced as if they're left for dead when they're really unlikely to be dead in all actuality. But that's maybe that's frustrating, but regardless, I think people are starting to say, you know what, I shouldn't act on my rational first principles kind of process of what I should buy, because the market is just not going to reward it. So what's the point? And I need a catalyst. What is going to be my catalyst for the stock price changing to what I think it's rational? So the interesting thing about catalysts is whenever someone asks you what's the catalyst, if the catalyst was black and white obvious, the stock would already have re-rated, right? Yeah. But let's think about what are some kind of catalysts that can happen. One is a market level catalyst, right? Maybe you have a period of easy money, a lot of liquidity, a lot of speculative juices flowing, and some external shocks, external event changes the mood to a more serious, less speculative mood, and all of a sudden things get revalued. When I started my career at Fidelity Investments in 2001, it was a couple of months before September 11th, and the economy was already entering the recession. Was actually in a recession at that point. We just weren't sure yet because the data was lagging. But then September 11th happened and the terrorist attacks, and that accelerated the recession, and that served as that final straw to completely pop the technology, internet, and telecom bubble of the late 90s. If you're sitting there, I don't know, in March of 2000, could you have predicted those things? No. Could you have looked at some of these valuations and said, these are absurd, like they make no sense? Or maybe one step below that, you know what, they're so optimistic as to be kind of in the hopes and dreams category, as opposed to in the, hey, have a reasonable chance of actually happening category in terms of the kind of fundamental developments that a number of companies would need to justify the then prevailing prices. You could have said that, but you would have said, well, what's the catalyst? Those were expensive in 99, they were expensive in 98, they were kind of expensive in 97. We had Alan Greenspan, the maestro of the Federal Reserve, tell us that there's irrational exuberance in 1996. So you're sitting there in 2000 saying, you know what, this has been this way for 3 years. This is a new market. I just don't get it. I don't see what the catalyst. It's just going to stay that way, right? And then boom, it pops. So impossible to predict, next scenario when it's going to pop. But that's kind of an example of an external event. You could also have company-specific catalysts, right? And that could be a deceleration of fundamentals. Because remember, let's say a company is growing 50% and the market loves it and the stock's doubling every 6 months, as we have some stocks literally that are doing that right now. Well, if a company only grows 20% or 25%, all of a sudden that's a big deceleration. And the momentum kind of junkies that feed on positive news are going to be disappointed. And just as there's a stampede to buy because other people are buying and the company is successful, the reverse can happen easily, right? And that's more of a company-specific disappointment. On the flip side of that, let's say you have a very cheap stock. Let's say it's at 5 times earnings or free cash flow. And just to level set what that means, when the stock is at 5 times free cash flow, that means that you're paying $5 for $1 of free cash flow. Now, if that dollar persists, meaning it's not going to decline, you're going to get a 20% rate of return just from that dollar staying flat. And that's a pretty good annual rate of return under any circumstance, right? Now, clearly, when the market is pricing at 5 times free cash flow, it's saying that this is a meaningfully declining business. It needs to decline a lot. And so let's say the company starts reporting results and maybe there's actually a very small level of decline, or maybe just it's actually flat. The stock might at some point get re-rated because there's enough evidence that it's not a rapidly declining business. And you might say, wait a second, Gary, are you telling me that one stock might go up after reporting flat profit growth and another might go down after reporting 25%, 20% profit growth? How does this make sense? Well, it's about embedded expectations, right? If you have some bubble stock at 40 times revenue or 30 times revenue, it doesn't take a lot of bad news to cut down the size. On the other hand, if you have a stock that's priced for rapid decline, just being flat is a big positive surprise. Now, I'm not talking about predicting quarters or whatever. I'm saying that if you're a long-term investor, as fundamentals unfold, if you're right on the long-term fundamentals, and by the way, that's what valuation is. Valuation is a lens on long-term expectations and on long-term cash flow streams. So as the cash flows unfold, you're going to be either proven more right or you're going to be proven wrong, right? Over time, incrementally. There's probably not going to be any one piece of evidence that's conclusive, but there's going to be kind of drip, drip, drip of new information that's should make you update your analysis, and also is going to cause the market collectively to update its analysis and valuation. So that's a kind of a fundamental scenario. Now, ideally, people who talk about catalysts, in the ideal world, you have a hard catalyst, and the hard catalyst is an actual event, right? It has a date. So if it's not a date, it's not a hard catalyst. Like, oh, I think they're going to beat the quarter. That's not a hard catalyst because they might or might not. You don't know. It's kind of like what everyone talks about in catalysts. But an event might be a restructuring. It might be a spin-off. Let's say you have two businesses, one is growing, the other is not, and the business that's not growing is, making the whole market dislike the combined entity, but maybe they split them off and the stock is cheap enough that the growth business is going to get highlighted on its own and revalued. So that's a hard catalyst because there's an event. It might or might not cause the re-rating that you're looking for, but at least it's an event. You can't argue that. Or in the case of a distressed bond, the maturity date, right? Let's say you have a high yield bond and you think it's money good, meaning it's not gonna default, it's going to pay back its principals. And let's say it's due in 18 months. And you say, okay, it's distressed, it's offering me a 15% yield to worst, attractive rate of return, I'm gonna buy it. And what's my hard catalyst? My hard catalyst is the maturity date, because the maturity date, you're going to find out. You either get your money back or you don't. And if you don't, there's other branches like do they file for bankruptcy, what the recovery rate is. That's a separate set of questions. But if you're right, and if your analysis, the reason you're buying is because you think you're going to get your money back on that maturity date, you're going to find out if you're right. That is a hard catalyst. So those are ideal. And I think those are legitimate catalysts, events or maturity dates, things with a hard date. But everything else, I think a lot of times it's hard. And if they were known, both in terms of timing and the direction, then they would likely be priced in. So I think that asking what's going to cause the stock or the security to be re-rated, I think it's the wrong question. I think it's a question driven by frustration of how the market is acting, that the market is not following the set of rules we would like it to follow. And I think a better question is, are we right today, not a year ago or 2 or 3 years ago when we initiated this investment? Are we still confident today in our assessment on the likely range of paths the stream of cash flows can take? Because if we're approximately right, and we have a big margin of safety in terms of the price, we are going to get a good return. We're also going to get things wrong many a time, hopefully the minority of the time as value investors, but a significant minority of the time. And it's very, very important to be reactive appropriately to evidence that we're wrong, because if we can just shave that percentage of being wrong a little bit, that can be meaningful in terms of our overall annual rate of return. So I think that I'm not saying we should ignore evidence. I'm saying ignore the price, but really focus on tracking the thesis, making sure that the stream of cash flows you believe is going to occur is still the most likely, or the range of cash flow streams that you foresee is still supported by the evidence you have. Anyway, I hope this has been helpful to you. If you like this video, please click like and subscribe to my YouTube channel. Thank you, guys.